Welcome to the deep dive. So, you've sent over this really compelling mix of recent news articles, all zeroing in on some pretty big economic shifts. We're talking tariffs, the U.S. credit rating downgrade, and, well, how the markets are reacting to it all.
Yeah, it's quite a collection.
Our mission here really is to connect the dots between these things that might seem separate at first glance. We want to understand the forces really shaping the economic picture right now.
Absolutely. And the sources are interesting, too. We've got Market Watch, CNBC, giving us that, market news and economic analysis.
Right.
And then pieces from Fox Business adding some of the political context around these developments. It gives a pretty rounded view.
It really does. And what strikes me is just how interconnected it all is. We're going to unpack, everything from Walmart's response to tariffs, what that actually tells us, to the real-world impact of the U.S. credit downgrade, and honestly, some pretty sharply contrasting views on where the economy is actually headed.
Definitely some different takes in there.
Okay, so let's dive right into these tariffs first.
Right. So this whole discussion, it really highlights that constant tension, doesn't it? Between trade policy and just the day-to-day realities for businesses.
Yeah.
We saw President Trump publicly taking issue with Walmart when they initially suggested tariffs would mean higher prices for consumers.
Exactly. It started when Walmart, I think it was in their first quarter report, basically said, look, U.S. tariffs on imports, that's probably going to raise prices at the checkout. And, well, that didn't go down too well, sparked a response. But then Treasury Secretary Scott Bessent came out with a slightly different angle.
Yeah, he mentioned that Walmart's CEO, Doug McMillon, had apparently indicated the company would absorb some of those costs.
Right, some. Drawing a parallel to how they handled it under the previous administration, it's this fascinating sort of push and pull.
It really is. And, the basic economics here are pretty straightforward. A tariff is a tax on imports.
Simple as that.
So it increases costs for businesses like Walmart that rely on those imports. Bessent's comment suggests there's an expectation, maybe even some behind-the-scenes talk, for these big players to, soak up part of that tax instead of passing it all on.
But how long can they do that? I mean, especially with shareholders to answer to.
That's the key question, isn't it? How sustainable is that?
Which kind of leads us nicely to what Fed Chair Jerome Powell has been saying. He's warning about potentially more frequent, more persistent supply shocks.
Right. Disruptions to goods flowing.
Exactly. And he specifically mentioned tariff risks at a recent Fed meeting, flagging them as something that could make inflation, well, a lot more volatile, more unpredictable.
Precisely. So even if some costs get absorbed initially, that underlying instability tariffs create, that's still a big worry for the Fed.
And it's not happening in a vacuum, is it? We saw that temporary 90-day trade truce between the U.S. and China.
Yeah, involves some mutual tariff cuts.
And the market reaction was immediate, right? U.S. stocks rallied, especially Tesla, NVIDIA. They saw big jumps.
Oh, yeah. It just shows how sensitive the market is to any hint of trade tensions easing up.
But here's the kicker, and it really shows the complexity. Even with that truce on some tariffs, China's apparently still blocking exports of 7 rare earth metals.
Ah, okay. That's significant.
Hugely significant. These aren't just any materials. They're vital for U.S. defense, energy, the auto industry. So you lower some tariffs, but then this other lever gets pulled.
That's a critical point. It shows that this isn't just about import taxes. Control over essential resources, technology. It's all part of the bigger picture of international economic competition.
Yeah. Okay, so let's look at some broader analysis. Morgan Stanley's perspective is interesting. They're basically saying, look, even with this tariff de-escalation, don't write off recession risks just yet.
They're pointing to direct and indirect effects.
Exactly. They cite history, the drop in U.S. industrial production, manufacturing jobs after previous China tariffs, and they make this really important point. A lot of imports from China aren't finished goods.
Right. They're capital goods, machinery, equipment, or intermediate inputs, components.
Yeah. So the tariffs end up being effectively a tax on our own domestic investment and manufacturing, not just stuff you buy off the shelf.
That's the crucial distinction. We often think tariffs just mean pricier TVs or whatever.
Right.
But hitting capital goods and inputs, that directly raises costs for American producers. It's like making a builder's tools more expensive slows things down, makes it harder to grow.
Definitely has long-term implications. Then you've got Jamie Dimon, J.P. Morgan Chase CEO. He's sounding pretty cautious.
Yeah, his view is that markets might be a bit too relaxed, too complacent about the risks from both tariffs and these record U.S. deficits.
He's actually predicting S&P 500 earnings growth could drop significantly because of all the uncertainty. not mincing words.
No, Diamond's perspective, coming from that top spot in finance, adds a serious note of caution. If corporate earnings take a hit, that's fundamental for the stock market
Yeah,
crash.
absolutely.
His warning about complacency suggests maybe the market isn't fully pricing in these potential problems.
But then flip the coin and you get White House Economic Director Kevin Hassett. He's painting a very different picture.
Yeah, talking about an economic liftoff once trade deals and tax policies fully kick in.
He basically dismisses the credit rating downgrade as backward-looking, focuses on strong job numbers, investment in capital equipment, argues the economy's fundamentally on the right track.
It's a stark contrast, isn't it? Really highlights how tough economic forecasting is, especially with major policy shifts and global stuff going on. Hassett's clearly banking on administration policies boosting growth.
And he's got data points like jobs and investment to back that optimism. Speaking of how tariffs actually play out, the aluminum example is really telling.
Ah, yes, that one.
So tariffs were put on imported aluminum, the idea being to boost U.S. production. But it's not really happening.
Why not?
Well, the reports point to rising electricity costs here in the U.S. compared to places like Canada, where energy is way cheaper. Our smelters are actually closing down.
Ah, so the tariff advantage is wiped out by other costs. Classic unintended consequences.
Exactly. So the tariff protection is there, but if your energy costs are through the roof compared to competitors, you can't really leverage it.
Which likely means those tariff costs are just being passed along to U.S. buyers.
Seems like it. Thule Group, the cargo box company, they raised prices specifically citing higher costs for raw materials like aluminum.
Right. Okay. Makes sense.
Okay, let's shift gears now. Big news on the U.S. credit rating. Moody's made a move.
They did. Downgraded the U.S. government's rating from the top era rating down to AA1.
So not the perfect score anymore. And their reasoning.
Concerns about the federal budget deficit, how much it's growing, and also the challenges of, rolling over all that existing debt when borrowing costs are higher now.
And this brings Moody's in line with the other big agencies, right? S&P and Fitch had already downgraded the U.S.
That's right. S&P back in 2011, Fitch more recently in 2023. So now all three major agencies see the U.S. at that slightly lower tier.
It's definitely a significant development. A lower rating signals what higher perceived risk.
Essentially, yes. Higher perceived risk that the U.S. government might struggle to repay its debts, which usually translates into higher borrowing costs for the government itself.
And we saw that play out immediately in the bond market, didn't we?
We did. Bond prices went down, which means yields, the return investors get, went up. Spiked, actually.
Yeah, the 30-year Treasury yield went above 5%, the 10-year above 4.5%. Those are levels that tend to make the stock market nervous.
Definitely. The reports mentioned these are the kinds of yield levels that have historically worried equity investors, and even made the administration rethink some tariff moves in the past.
Shows how connected the bond and stock markets are. When yields on safer government bonds rise, riskier stocks can look less attractive.
It's fundamental finance. Higher Treasury yields can pull capital away from stocks, putting pressure on valuations. It's why everyone watches those yield movements so closely.
But just like with the tariffs, the administration is pushing back hard against this downgrade.
Not surprising. Treasury Secretary Bessent called it a lagging indicator.
Right, suggesting it reflects old news, past fiscal conditions, maybe even blaming the previous administration. And he stressed commitment to cutting spending, growing the economy.
It's a standard playbook, really. Argue the rating agencies aren't seeing the positive effects of current or future policies yet.
And the White House press secretary, Caroline Leavitt, echoed that. Said the president disagrees with the downgrade, pointed to recent investment announcements as signs of confidence.
Trying to counter the narrative.
Then there was that Stephen Moore opinion piece. He really went after Moody's credibility.
Yeah, suggesting political bias, even bringing up Moody's past issues with ratings during the subprime mortgage crisis.
Right. He questioned why there wasn't a downgrade during times of big spending under other administrations, implying the timing was suspicious, linked to tax cuts he supported. Adds a layer of skepticism about the whole rating process.
It does. Moore's piece taps into that ongoing debate about fiscal policy, politics, and economic assessments. And referencing Moody's past penalty reminds people these agencies aren't infallible.
It's useful context. The articles also provide some historical perspective on ratings and defaults.
Yeah, apparently no country with a AAA rating has defaulted within 10 years. And only one AA country, Cyprus, has defaulted since 1983.
So while the downgrade is significant, that history suggests the actual risk of the U.S. defaulting is, well, still seen as very low.
That data offers some reassurance, for sure, but, past performance isn't a guarantee. Still, it puts the downgrade in a broader context.
Interestingly, amidst the concern, a Morgan Stanley strategist apparently saw the market dip after the downgrade as a buying opportunity.
Always different perspectives in the market. Some see risk, others see opportunity.
And Jamie Dimon, staying true to his cautious stance, basically said the downgrade reflects real risks from the deficits that maybe the market is underappreciating.
So yeah, a real range of reactions from financial experts highlights the uncertainty, doesn't it?
It really does. Okay, let's widen the lens a bit. Look at other economic signs, broader market reactions.
Right. So despite that Moody's downgrade, U.S. stocks actually managed a winning week overall.
Driven largely by that U.S.-China trade truce news we talked about.
Exactly. S&P 500, Dow, NASDAQ all saw decent gains. Tech stocks like Tesla, Nvidia really led the charge.
But then things wobbled a bit.
Yeah, U.S. futures dipped slightly afterwards, and markets in Asia-Pacific fell. Part of that was linked to some weaker-than-expected retail sales figures coming out of Beijing.
Just shows how globally interconnected everything is. News from China moves markets here.
Absolutely. It underlines how sensitive markets are to both geopolitics, like trade talks, and fundamental economic data, like consumer spending in major economies. The initial relief rally was tempered by those underlying economic concerns.
We also saw some movement in Europe. UK government borrowing costs went up.
But the British pound actually rallied.
Right. Following that new agreement between the UK and the EU, aimed at resetting the post-Brexit relationship, shows how political news can directly hit currency and bond markets.
Definitely. The market clearly saw that UK-EU agreement as potentially positive for the UK economy, hence the pound strengthening.
There was also that slightly dramatic quote from a trader.
Oh, yeah.
Someone who apparently called the S&P 500 bottom correctly, but is now warning about a potential flash crash.
Flash crash, wow. What's the reasoning?
Interestingly, he linked it partly to Warren Buffett's upcoming retirement. Suggested losing such a huge, stabilizing figure could increase market volatility.
Huh. That's an interesting take. Highlights the psychological side of markets, the influence of figures like Buffett. Any perceived shift in stability, even symbolic, can fuel uncertainty.
Yeah, maybe a bit speculative, but thought-provoking. We also got some data on the retail sector.
What's happening there?
Store closures are up, especially in soft goods, clothing, home stuff. The analysis suggests stronger brands are grabbing market share from weaker ones.
Consolidation, basically.
Yeah, but meanwhile, the off-price retailers, the discount places, they're actually expanding. Paints a picture of consumers really focusing on value.
Makes sense. Reflects that ongoing shift in consumer behavior, probably heightened by economic uncertainty. Value and price sensitivity are key.
And some big individual stock moves, too. United Health Group had a massive two-day surge.
Right, its best since March 2020, after a previous drop.
Yeah, quite the rebound. And IBM hit an all-time high. The report noted, 22 S&P 500 stocks hitting 52-week highs.
With 17 of those hitting all-time highs. Pretty concentrated strength.
But small-cap stocks were lagging behind, so not a broad-based rally across the board.
No, it suggests investors might be favoring larger, more established companies right now. Could be a flight to perceived quality or safety within the equity market.
And here's another interesting global flow. Overseas investors apparently piled into Japanese assets in April.
Ah, Japan is a safe haven.
Seems like it. Coincided with what was described as a growing sell U.S. narrative among some international investors. Maybe a shift in where global capital sees safety and opportunity.
That makes sense. Investors constantly reassess risk and return across different markets. Japan's traditional safe haven status seems to be drawing capital in this environment.
Now, something hitting individuals directly and quite hard. Student loan delinquencies.
Oh yeah, that's a growing concern.
Credit scores are plummeting for millions now that the on-ramp repayment period has expired.
And the impact of a big credit score drop can be brutal, right? Affects everything.
Everything. Future loans, mortgages, insurance rates, sometimes even job prospects. The article stressed the potential for long-term financial consequences, but also offered some advice on recovery.
It really highlights the direct link between policy decisions and individual financial health. A tough situation for many borrowers.
Definitely. And finally, just touching on some business news, Regeneron is buying most of the bankrupt 23andMe's assets.
Right, for about $256 million. Interesting move.
Key point is they've committed to upholding 23andMe's privacy policies for all that genetic data.
That's crucial given the sensitivity.
But 23andMe's telehealth business, Lemonade Health, is being shut down as part of it.
So Regeneron wants the data and the customer base, likely for R&D, but not the telehealth side. Streamlining the acquisition.
Yeah.
Reflects that convergence of pharma and tech data.
Okay, and just briefly on the wider international stage, Saudi Arabia committed a huge investment in the U.S., $600 billion.
Wow, that's substantial. Focused on tech and defense.
Yeah, significant foreign direct investment. And President Trump has a trip planned to the Middle East.
Lots on the agenda there, I imagine.
Big time. Israel-Gaza ceasefire talks, oil, trade, investments, semiconductors, nuclear programs. A really packed diplomatic schedule. Seems like a critical time globally.
Absolutely. These engagements just underscore how tied together global economics and geopolitics are. That Saudi investment, the president's trip, it all points to complex relationships shaping trade and investment worldwide.
So, wrapping up this deep dive, a few key themes really stand out, don't they?
They do. That constant tension between tariff policies and inflation is one.
Right. And then the uncertainty swirling around the U.S. credit rating downgrade with such different takes on what it actually means.
And all of this playing out against a backdrop of market volatility, shifting investor sentiment, influenced by global data, political moves. It's a lot.
It is. And navigating it really requires you, the listener, to consider all these interconnected pieces. Developments in one area, like tariffs or interest rates, ripple out everywhere.
Affecting big companies, small businesses, individuals. Everyone feels it one way or another. Understanding these dynamics is pretty crucial.
Absolutely. Which leads us to a final thought for you to mull over. Given everything we've talked about, the conflicting signals, the different analyses on tariffs, the downgrade, market reactions, global shifts, what single factor do you think will be the most significant driver of the economic path over the next year?
Yeah, and maybe more importantly, why do you think that? What's your reasoning?
Definitely something to keep thinking about as these stories continue to unfold. Thanks for taking this deep dive with us today.